U.S. natural gas futures ended the week under pressure, as shifting weather expectations and steady production growth offset still strong LNG demand. The market continues to trade in a relatively tight range, with traders balancing supportive export flows against softer domestic consumption prospects heading into late February. On the fundamental side, LNG exports remain near record highs, helping to absorb a significant portion of supply and keeping a firm floor under prices around the $3 area. Feed gas flows to major export facilities have stayed elevated, limiting the pace at which storage deficits can narrow. However, updated weather models are increasingly pointing to milder conditions across key demand regions. Warmer than normal temperatures are expected to reduce heating demand, leading to smaller withdrawals from storage in the coming weeks. At the same time, dry gas production continues to trend higher, hovering near multi-month highs. The latest gas rig count report released on Friday showed that the number of active rigs continued to climb, reaching 133, signaling that drilling activity is accelerating and future production capacity is expanding further. The combination of rising output and softer weather-driven demand is starting to shift sentiment. While storage remains below last year's levels and the 5-year average, the deficit could shrink quickly if mild forecasts verify. That possibility is keeping buyers cautious and encouraging a sell-the-rally approach among short-term traders. Meanwhile, an interesting dynamic emerges when we compare the weekly natural gas rig count and weekly LNG carrying capacity data against price action. As shown on the charts, two opposing forces are at play: bullish growth in LNG carrying capacity and a bearish rise in the natural gas rig count. However, prices continue to trend lower, aligning more closely with the bearish force of expanding production driven by the increasing rig count. This pressure is further reinforced by the expected decline in demand as warmer weather patterns reduce heating needs. From a fundamental standpoint, this setup could persist for at least the next 2 months, or until cooling demand begins to pick up and provides a new layer of support for prices. From a technical perspective, the $3 level remains a critical psychological and structural support zone. Each dip toward this area has attracted buying interest, suggesting strong underlying demand and positioning. On the upside, resistance is developing near the $3.30 to $3.40 region, where previous rallies have stalled. A sustained break above that zone could open the door toward $3.60, while a decisive move below $3 could trigger accelerated selling toward the $3 to $2.80 range. Momentum indicators on the daily chart have flattened, reflecting the current consolidation phase. The market appears to be waiting for a stronger catalyst, most likely in the form of a meaningful shift in weather forecasts or a surprise in upcoming storage reports. Overall, the weekly outlook remains neutral to slightly bearish in the short term due to softer weather expectations and solid production, but structurally supported as long as LNG demand stays elevated and the $3 level continues to hold. If you're looking for a more detailed breakdown of the market, consider joining the channel. I've launched channel memberships with more in-depth content. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here. See you in the next update.